So let's get cracking. It's been an incredible few days, and I concluded the previous webinar last month by saying that we didn't have a clear view on things, which is sometimes a good idea because you want to stay out of markets when you don't have the clarity, and I will take you through exactly why I said what I said. We've now had a pretty tumultuous few days, which I'm sure you've all been facing in your own different ways, how you've handled the volatility in markets. So what I'd like to do today is really give you a complete global picture of how I see markets panning out through the summer, how you should be running your trading and investing books over the next 4 to 8 weeks, maybe the next 3 months, and how you want to completely, absolutely completely block out the noise that comes from reading the Financial Times and reading various opinions on the internet, which range from being extremely bearish on what's happened recently to now that we've had a dramatic rally in the FTSE, starting to say that, okay, maybe things are not that bad. So really, opinion on the internet and opinion from experts should not matter to you. Even what I say should not matter to you, but what should matter to you is your interpretation of price action. So let's dive straight in. It's going to be a fascinating few slides that you will look at. So welcome to TradingHD. Quick disclaimer and risk disclosure before we begin. The information contained within this presentation is intended for educational and illustrative purposes only and does not constitute investment advice. Do not make any investment decisions or other decisions based on the material presented. We cannot be held responsible for your trading results. For more information, please visit www.tradinghd.com. So that's out of the way. A little bit about myself. If some of you have only recently come to this webinar, we've been doing these for the last 9 months now, once a month, and I hope you've been finding it of use. That's a little bit of a background on myself. I've been a stockbroker for many years, and I speak to some of the world's largest hedge funds on a daily basis, trying to figure out the best long and short ideas for them. And this is something that I like to do, which is speak to professional traders across the world and talk about how I use my system to take a look at where the world is and find the best ideas. A little bit about myself from Lex Van Dam, who has been one of my clients for many years, and who obviously I respect a lot, and it's nice of him to give us a good testimonial. Right about more than anything else, just following a disciplined approach, I suppose, which is the most important thing for anybody in markets. So let's go straight in and talk about the one chart that I have been talking about consistently since our first webinar in October of 2015. And for those of you who have actually studied my lectures that I post on tradinghd.com and actually taken the time to look at the 90-minute video, what you will find is my use of 3 extremely powerful indicators, in my opinion, that will more often than not keep you on the right side of the big markets trend, and which in itself is worth a lot of information. So you have the price chart, you have the 45 EMA, and then you have the 200 period moving average. You have 14 period RSI, which in this case is a monthly price chart of the S&P. One of my contentions, and well, it's not really a contention, it's my observation for the last 20 years looking at markets, is that some of the most dramatic moves tend to happen around the RSI level of 60. So when you break an RSI level of 60, as the cursor currently shows you, in 2000, we started a big bear market. We then broke below 60 again in 2008, started another big bear market. And we broke below 60 in 2015, only to bounce right back up again, fail at 60, give another pullback, fail at 60 again, give another pullback. So the last 9 months should give you enough evidence that the level of 60 is something to very, very closely monitor. I remember very clearly that in the middle of this month, the RSI was trying to break above 60. And a lot of people got very bullish at the recent highs. That was before we had the Brexit fiasco. It may not necessarily be a fiasco longer term. I have my own views on that, but at least it was a fiasco immediately for a lot of traders on the Friday morning. And one of the things that kept me away from being bullish on the market was the fact that the monthly RSI had not been able to close above 60. And despite the rally that we've recently had in the last 3 days, we still have not been able to close above 60 on a monthly RSI timescale, which actually tells me that despite this very strong move from the recent lows, you still have to be very careful of getting sucked into getting too bullish on this market till we get a monthly RSI close above 60. But a monthly RSI, you have to wait for a whole month to actually get the data point, which is not a bad thing because it keeps you on the right side of the big trend. But for those of you who like to watch stuff more closely on a week-to-week basis, here is something which is absolutely crucial to appreciate, that for 2013 and 2014, we had the RSI consistently above 60. Every time it came towards 60, it went below 60 only for very brief periods of time and bounced right back. But more critically, at no point did it ever break the 45 EMA. This whole period, that was a fantastic trending phase for the S&P. And then something happened in 2015, where my cursor is right now, where the RSI was no longer punching above 60, started to fail multiple times at 60. In fact, every time we got to 60, it was a great selling opportunity. More critically, every time it got close to 40, which is, as I explained in my lectures, one of the strongest support levels on a weekly time scale. Every time it got towards 40, it was a great buying opportunity. In 2015, after the big August crash, it was the level of 40 that kind of gave some support. And once we went back through 40 again, we were ready to rally again. We then failed at 60, and it was a great time to go short again. So the point being that in the last 1.5 years, what the market has done is go sideways aggressively within a 60 and a 40 RSI range on the weekly chart. There is no evidence to suggest yet, as you can see, the weekly RSI is at 54 right now. There is no evidence to suggest that we are in a bull market back up again yet. What I do like about the prospect of a bull market here now is that if we were able to penetrate through this sideways period, which is something that you should watch very carefully over the next month, that if we are able to get out of this box to the upside, and if the RSI closes above 60 on a weekly time scale anytime from next Friday onwards, so this call activates today, that if we are able to get a weekly RSI close above 60, we could be in a period where the S&P actually breaks to the upside. I'm not expecting it right now, and the reason I'm not expecting it is you will see many other slides down the track as I show you. There is scant evidence to suggest to me that the cyclical part of the US stock market is acting well. It is not acting well, and that is why I believe that perhaps we will continue to go sideways for a little while before we start the trend. On the flip side, what I would also say is that if we were able to break the low that was made, where my cursor is exactly, as you can see, was at the 45 EMA, the blue line, if we're able to make a weekly closing below here, I can say with complete confidence that we're going to break this low of earlier this year. This is a very high conviction call, which you should act upon if we are able to get a Friday close, which as you can see is around 2033. It's kind of hidden on the chart here, but it's about 2033 on the S&P cash.